Good day, everyone. Our group will be discussing Chapter 6, Accounting for Overhead. To formally start this presentation, I will first define what product cost is. So, product cost includes cost of direct material, direct labor, and manufacturing overhead. Our discussion will mainly focus on manufacturing overhead. So, manufacturing overhead is an indirect product cost included in the production cost aside from direct materials and direct labor. This includes the following: taxes, indirect material, indirect labor, insurance or the expired portion, rent, repairs and maintenance, utilities, and depreciation. This manufacturing overhead are simplified as TRUD. The journal entry to record the incurrence of overhead simply debit overhead and credit various accounts. These various accounts pertain to TRUD. The journal entry to record the incurrence of overhead applied to the job under actual costing method is to debit work in process and credit factory overhead. Moreover, the factory overhead under this method has no variance since actual overhead incurred is charged to work in process. The journal entry to record the incurrence of overhead applied to the job under normal costing method simply debit work in process and credit factory overhead, which is the actual overhead incurred. Unlike actual costing, normal costing the factory overhead may have a variance once the amount of overhead actually incurred is greater than what is charged to the job in process. Next, the journal entry to record the underapplied overhead is to debit cost of goods sold and credit the applied factory overhead. The overhead is said to be underapplied if the overhead applied to the job is lesser than the amount of overhead actually incurred. On the other hand, the journal entry to record the overapplied overhead simply debit the applied factory overhead and credit cost of goods sold. The overhead is said to be overapplied if the overhead applied to the job exceeds the amount of overhead actually incurred, which definitely is beneficial since less has been spent over the anticipated level of achieved production. Predetermined overhead rate is used to calculate the amount of overhead applied to the job. Predetermined overhead rate is an allocated charge used to apply manufacturing overhead to products or job orders, and mostly computed in the beginning of each period. To compute the predetermined overhead rate, divide the budgeted manufacturing overhead cost by an allocation base, also known as activity base or activity driver. These allocation bases are direct labor hours, direct labor dollars, machine hours, and direct materials. To fully understand predetermined overhead rate, here is an example to solve. We are required to first solve for the predetermined overhead rate, and second, to identify if the applied overhead is underapplied or overapplied. Problem 1. Factory overhead for the King Manufacturers Company has been estimated as follows. Fixed overhead is 15,000, variable overhead is 45,000, estimated direct labor hours is 20,000. The production of the month reached 75% of the budget, and the actual factory overhead totaled 43,000. First, to compute for the predetermined overhead rate, we will use the formula budgeted manufacturing overhead divided by budgeted production activity. This is 15,000 plus 45,000 divided by 20,000. And this is equal to 3 direct labor hours. And therefore, next, to determine if the overhead is under or over applied, solve for the applied overhead first. This will give us 20,000 times 75% times 3 direct labor hours. This will equal to 45,000. So the applied overhead is 45,000 while the actual overhead is 43,000. Therefore, the overhead is over applied by 2,000. Here is another given example. We will first solve for the predetermined overhead rate. Second is to compute and identify if the applied overhead is under or over applied. And lastly is to prepare the journal entries to close the under or over applied overhead. Problem 2. X company uses job order costing. It applies overhead costs to the job on the basis of direct labor cost. For the current year, the company estimates that it will incur 25,000 in direct labor cost and 550,000 of manufacturing overhead. During the year, 30,000 of direct labor costs were incurred. Actual overhead incurred were indirect material expense 100,000, insurance expense 10,000, depreciation expense 75,000, indirect labor expense 150,000, utilities expense 25,000, and rent expense 200,000. First, to solve for the predetermined overhead rate, we will divide 550,000 by 25,000, and this will give us 22 direct labor hours as the predetermined overhead rate. Next, to determine if the overhead is under or over-applied, solve for the applied overhead first. 22,000 times 30,000 is equals to 660,000. So the applied overhead is 660,000 while the actual overhead is 560,000. Therefore, the overhead is over-applied by 100,000. Lastly, to record the journal entry to close the balance of the manufacturing overhead account, we will debit manufacturing overhead for 100,000, which is the over-applied overhead, and credit cost of goods sold for 100,000. The next topic is accounting for overhead using departmental overhead rate. Departmental overhead rate is a standard charge depending upon the units of activity produced of a business segment. Overhead rates at the departmental level are applied usually in a more refined cost allocation environment, which means that overhead cost must be applied as precisely as possible. A manufacturing company normally has 2 or more production departments, which may use production technology that is different from other departments. Therefore, the departmental rate is recommended to allow each department to choose the most appropriate measure of activity suitable to its operation. It is more accurate than plant-wide rate, considering that manufacturing overhead incurred various overhead costs depending on the relationship to their manufacturing process. Here is a given example to compute for manufacturing overhead using departmental rate. Sunflower Manufacturing Company has two producing departments, assembly and finishing department. Assembly department has significant amount of labor-related overhead, and it uses direct labor hours as the cost driver, while finishing department has significant amount of machine-related overhead, and it uses machine hours as the cost driver. The data are available for Sunflower Manufacturing Company for the year just ended. For our budgeted data, we have manufacturing overhead that has 1,890,000 for assembly and 1,260,000 for finishing. Direct labor hours has 52,000 for assembly and 20,000 for finishing. Machine hours 15,000 for assembly and 80,000 for finishing. Next, for our actual data, we have direct materials used per unit 120 for assembly and 50 for finishing. Direct labor cost per unit is 2 hours at 37.5 per hour at assembly and 0.75 hour at 37.5 per hour at finishing. Machine time used per unit is 30 minutes for assembly and 3 hours for finishing. The actual production is 25,000. Here is the summary of production cost derived from the data provided under departmental rate. For our cost elements, we have direct material, 3 million for assembly, and 1,250,000 for finishing. This will give us a total of 4,250,000. For direct labor, we have 1,875,000 for assembly, 703,125 for finishing. The total is 2,578,125. Next is factory overhead that has 1,817,000 for assembly and 1,181,250 for finishing. Total is 2,998,750. The total cost for assembly is 6,692,500 and 3,134,375 for finishing. The overall total is 9,826,875. Provided is the solution to compute for the overhead of two departments using departmental rate. Under the assembly department, we will use direct labor hours as our cost driver, since the rule in departmental rate is whichever cost driver is higher will be used. First, to compute for the overhead rate, we will divide manufacturing overhead by direct labor hours. So 1,890,000 divided by 52,000 is equals 36.35 direct labor hours. To compute for overhead applied, we simply multiply actual production units by direct labor cost per unit and then by overhead rate. Therefore, 25,000 times 2 direct labor hours times 36.35 is equals to 1,817,500, which is our overhead applied. On the other hand, the finishing department uses the machine hours as cost driver since it is higher than labor hours. First, we will compute for the overhead rate, 1,260,000 divided by 80,000. This will give us 15.75 direct labor hours. To compute for the overhead applied, we simply multiply the actual production units by machine time used per unit and then by overhead rate. Therefore, 25,000 times 3 machine hours times 15.75 is equals to 1,181,250, which is our overhead applied. Our last topic will be about accounting for overhead using plant-wide rate. Plant-wide rate is a single overhead rate a company uses to allocate all of its manufacturing costs to one cost pool. It is one of the most common and simplest allocation of overhead. However, its accuracy is not absolutely guaranteed. To further understand how to compute overhead using plant-wide rate, here is a given example. For our problem 1, Sunflower Manufacturing Company has two producing departments, assembly and finishing department. Assembly department has significant amount of labor-related overhead, and it uses direct labor hours as the cost driver, while finishing department has significant amount of machine-related overhead, and it uses machine hours as the cost driver. The following data are provided. For budgeted data, manufacturing overhead has 1,890,000 for assembly and 1,260,000 for finishing. Direct labor hours has 52,000 for assembly and 20,000 for finishing. Machine hours contains 15,000 for assembly and 80,000 for finishing. Next is for the actual data. Direct materials used per unit, 120 for assembly and 50 for finishing. Direct labor cost per unit is 2 hours at 37.5 per hour at assembly and 0.75 at 37.5 per hour at finishing. Machine time used per unit, 30 minutes for assembly and 3 hours for finishing. The actual production is 25,000. Here is the summary of production costs derived from the data provided under plant-wide rate. For our cost elements, direct material has 3 million for assembly and 1,250,000 for finishing, and the total is 4,250,000. For direct labor, 1,875,000 for assembly and 703,125 for finishing. The total is 2,578,125. Next is factory overhead that has 2,187,500 for assembly and 820,312.5 for finishing. The total is 3,007,812.5. And the total cost for assembly is 7,062,500. For finishing is 2,773,437.5. The total is 9,835,937.5. Here is the computation for direct material and direct labor under departmental rate and plant-wide rate. For direct material, in assembly, 25,000 times 120 equals 3 million. For direct material in finishing, 25,000 times 50 is equals to 1,250,000. For direct labor, in assembly, we have 25,000 times 2 hours times 37.5 is equals to 1,875,000. For direct labor in finishing, we have 25,000 times 0.75 hours times 37.5 is equals to 703,125. To compute for overhead rate under plant-wide rate, we will use the formula of budgeted overhead for the whole plant of 1,890,000 plus 1,260,000, and we will divide it by the total estimated level of activity of 52,000 plus 20,000. This will give us the amounts of 3,150,000 for budgeted overhead for the whole plant and 72,000 for total estimated level of activity. The answer for this is 43.75 direct labor hour. Lastly, the computation for overhead applied under plant-wide rate for two departments are: overhead applied. OH in assembly is 25,000 times 2 times 43.75. This will give us the amount of 2,187,500. The OH in finishing is 25,000 times 0.75 times 43.75, and the amount is 820,312.5. And this is the end of our report of Chapter 6, Accounting for Overhead. Thank you for listening.